Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so this week we're going to start tying up the loose ends of the asset allocation process. We're going to discuss quite a cluster of concepts, but they are quite important in the asset allocation process. So in this week, we're going to talk about the investment process, which is for your general information only, so you understand what's involved in the investment process. It's related to asset allocation as well, but the requirement on this section, the investment process, is very general for your interest only. We're going to focus our discussion on the multi-manager investing and the active versus passive debate. These two sections are very important, the considerations when we allocate funds into different asset classes. And here we're going to look at the structure within a total portfolio. So the asset allocation among different asset managers, and also the asset allocation towards the active or passive financial assets, the products. So there are different dimensions of asset allocation. Previously, we have always been focusing on asset allocation in terms of asset classes. So here we extend that dimension to manager diversification and also the choice between active and passive products. And lastly, very importantly, we're going to talk about the impact of the fees, the cost of investment on our investment decision. With the investment process, so you probably can find the definition from the textbook, and also I give you an example from Colonial First State of an Australian small shares. You might have a read of their investment philosophy, the investment objective, and the risk and return profile of the fund to get some ideas around this very particular product. The investment process actually is a procedure that the fund manager puts together so that everyone within the team will be on the same page and they're working towards one objective within the defined boundaries of the fund mandate. So that will define what we do within the fund and the objective we're going to achieve and how we're going to take people into responsibilities. So that's the investment process. It sets rules for different peoples within the team. Here's the so-called definition of investment process. So first of all, we have to define an investment philosophy. If it's an actively managed equity fund, how are we going to generate alpha? How are we going to outperform the benchmark? So the investment philosophy will state the ideas, the structure, the concepts the manager wants to follow to generate this alpha or outperform the benchmark. So the philosophy will be for value equity managers that may be, okay, we actively select long only. We actively select undervalued stocks on a group of measures and try to achieve an absolute return of certain percentage over an investment horizon, for instance, at least 5 years. So that's usually defined in the investment philosophy and also part of the objective of the fund. The signal creation is a process that probably will very likely to involve the quantitative side of the investment process or so-called security selection. So it's going to define the kind of measures we're going to capture. We're going to create the signal. For instance, if we are selecting value stocks, value Australian stocks, we're going to use the signal of value measures. For instance, PE ratio or other alternative measures of value, not just price to earnings, reported earnings, or properly price to normalized earnings, or relative price to normalized earnings. These bunch of measures will help us to create signal. And during the process, they usually set a hurdle so that only the stocks that exceed this hurdle, they might become candidate to be included in the portfolio. So we have the signal creation process. We define the quantitative measures we're going to use to capture the signal. And then we're going to start the signal capture. With every day, every second, new information will come into the market of a particular company, an asset. So the signal capture process will calculate, process actively, try to create summary statistics or any ranking data, ranking information of all of the listed Australian companies. And through this process, you may distinguish the firms that are more likely to be undervalued but of good quality from the rest of the firm. Then these firms will become the candidate to be included in your portfolio. Implementation. So with the implementation, you have to consider buying or selling a particular stock. Will that transaction move the market price? That's probably not something you consider as an individual investor, but for institutional investors, especially within a very small equity market in Australia, the fund managers have to consider whether the buy or sell orders will move the market price. Then they have to consider the bid-ask spread, the realized capital gain tax, and other. Is there any other benefits like capital loss? So they have to evaluate the trade-off of the potential benefits and potential costs of doing the trade. Then they ask the broker to buy or sell on their behalf. And the last step of the investment process is the review of the whole investment process. Is there any way we can refine our investment philosophy? Or are there any ways we might refine the signal creation or signal capture? Or can we improve efficiency in the implementation process? And how the portfolio manager's performance is going to be evaluated. And they may run performance attribution. So you might attribute the excess return over the benchmark as driven by skill or driven by luck or any other factors. Then there will be a feedback process. We go back to refine the whole investment process. You're going to have a tutorial exercise on this. I'll give you Colonial First Australian small shares. You may have a read of the facts of the fund and try to imagine how they may, especially how they may get the signal created and signal captured within the investment process. So it's for general understanding only. It's not going to be examined in the exam. The investment process dimensions, they are not exclusive to each other. For instance, if I'm a manager of doing bottom-up security selection, that means I work closely on very detailed information on particular companies or assets. And then I go up to understand the overall industry performance in my security selection process. Of course, the other managers, they might focus on the relative performance of an industry or a group of industries against the rest of the market or against the other industries. So they might have different approach in terms of security selection, but are not exclusively to each other. The fundamental driven, for instance, fundamental means that you do the discounted cash flow valuation, and you try to create signals of whether they are properly priced or underpriced or overpriced. But at the same time, you probably want to introduce market timing bets into your trading, into your investment process to take advantage of temporary mispricing. So these approaches can be combined together to create an investment process. They are just different dimensions. How managers, especially active managers, generate the excess return, and how we're going to understand their efforts in the process is actually will form our debate over our choice of active versus passive products in the investment market. So here we are going to have a look at a very important piece of work from the Journal of Portfolio Management. It's an old piece that's more than 20 years old, but it's an important piece of the puzzle to lay out the future development of our knowledge in this area. So especially when we have looked at the performance of a portfolio, we probably have portfolios of a DB fund, of an actively managed mutual fund, for instance, an active Australian equity fund, or an individual investor who has retired and really relying on the coupon payment or dividends of the portfolio to pay for the bills and everyday living cost. So not all of these investors really care about tracking error. Who are more likely to care about tracking error, information ratio, or how they're going to generate a positive alpha? The DB fund or mutual fund manager or individual investor? Maybe I should write this down. We have DB fund and mutual fund and an individual investor. So out of the three investors, who is more likely to care about generating alpha, tracking error, peer risk? Mutual fund, yes. So when we discuss how the investors generate positive alpha or beat the benchmark, we actually discuss this topic in the context of most likely to be a mutual fund manager who's given a well-defined benchmark to outperform as to evaluate their performance. So that's the context of this discussion of skill versus breadth. So that's we're going to understand how they're going to outperform the performance attribution of these active managers relative to a benchmark or a passive index in this way. Information ratio, which is the excess return over the portfolio excess return over the benchmark for every unit of peer risk. So that's the information ratio. You have done this calculation in the tutorial exercise, and particular for the attempts to fine-tune your portfolio, introduce new assets when you're considering asset swaps. So you probably want to calculate the information ratio. We are interested in this ratio, how much excess return you may generate for every single unit of peer risk. So obviously, I benchmark my performance against a comparison group or peer performance. So it's named as information ratio because it's going to provide insight into how well my investment idea will generate excess return for me, but not deviating too much from the benchmark. That's the every unit of peer risk. Sometimes fund managers may decide they're willingly to deviate from the benchmark asset allocation. That's the tilting, overweight on particular asset or asset class, underweighting some assets or some asset classes. They willingly take on the tracking error risk in the hope to generate larger excess return. So that's what active managers would like to achieve in portfolio tilting, underweighting, or overweighting. Information ratio can be decomposed in a way that will help us to gauge the skill of the fund managers. That's what we have today. It's going to be a product of information content and the number of trades involved in the investment process. So in this way, we may separate some sort of separating the skills, that the information content, and the number of trades or bets made by the portfolio, by the fund manager. So if we keep the number of bets constant, the higher information ratio, the higher information content you have, or in other words, the more skills you have in selecting the undervalued stocks, the higher information you get. That's why we have this framework to help us to understand how active managers' performance can be evaluated and how we're going to understand the different investment styles and how this investment style is going to be associated with their performance. If we keep the information content constant, then the higher, the larger number of bets they make in this investment process, and on average, they make corrected bets, and the higher information ratio they're going to generate. So when we keep the information content constant, it might imply that, okay, we only bet on one particular dimension, but sometimes we're not very quite sure how this is going to move, so I try so many times. On the average, over the process, I'm going to refine my investment process, my signal creation and signal capture process, and eventually, I believe on average, I'm going to make correct bets. Or in other words, out of the large number of bets I made in the investment process, I make right calls more than the wrong calls. So that's another way of generating active return or positive alpha for some active managers. But either way, you have to have some skill involved, because even for the funds managers who are really trading on breath, they do a lot of trades, they still have their belief in there. It just takes a lot of bets to identify the correct skills, the right signals within the investment process. So no matter the active manager is relying on breadth or skill, some skills must be involved. So this is the process to help us to understand how we're going to evaluate the active manager's performance. So with the managers who are heavily relying on information content, they believe they have superior information, insights, experience, and they can make better choices than the average investor or the average fund managers in the market. So with these managers, they probably don't trade that often as the managers relying on breadth. They make discrete or few bets, but they make every bet really large to generate a significant positive alpha or information ratio. So the disadvantage of these kind of active investors will be if they make a wrong call, the impact on the portfolio performance can be quite significant. But if they are right with one particular large bet, they're going to reap benefits of outperformance and, of course, bonus. With the active investors who are relying on breadth, the trading, a lot of trading, fine-tuning their investment process, and they are trying to have, on average, correct bets, every trade can be much smaller than the managers relying on skill, and they're doing this trial and error process. Every bet can be much smaller. Even if they make a wrong call, the impact on the portfolio can be quite limited. But there's a disadvantage. What's that? If they trade a lot, they buy and sell one security frequently. What's the drawback of this investment process? Anyone? I heard something. Yes, transaction cost. So for the managers, for the active managers who are relying on breadth, one single bet, one single trade may have very small impact on the overall portfolio, but because they trade frequently, they are going to incur large cost. So it's going to be a trade-off for the fund manager. The tracking error is going to be like a revision from previous weeks. So the fund managers, especially those who are actively managing their portfolio, are particularly worried about their tracking error. This will put them in the top quartile or bottom quartile of the Morningstar ranking. Of course, this is going to be associated with their promotion, their bonus as well. For an active equity funds, the tracking error of below 2% is considered quite reasonable, or the level of tracking error that you may have the chance. You have to take on some tracking error or peer risk to try to generate alpha. So below that level, you probably should be okay, but you have to make sure for that peer risk, you are able to generate excess return. When the tracking error is very high, close to 5% or even above 5%, you probably want to be extra careful. You are overweighting or underweighting relative to the benchmark by a large margin. And you have to generate this enough excess return to justify that additional peer risk you're taking on in your portfolio. Actually, this discussion of the active managers will lead us to later discussion of investor choice between passive and active products. The transaction cost involved, the sort of risks perceived by investors are all important considerations in their asset allocation when they allocate funds in passive or active products. In week 6, we had a little bit discussion of investment style. So we tried to have a look at the correlation of equity fund managers, or we might run regressions of the equity fund managers against passive stock index or other factors to understand their investment style. So here we're going to extend that investment style to the another level of investment process. So since portfolio managers may follow quite different investment process, even though they may follow a very vaguely defined investment philosophy. For instance, value equity managers. They may claim they ought to be value managers, but they actually follow quite different investment process in terms of signal creation, signal capture, and the whole process of their security selection. So that's how investment style and process can be quite different for the same managers of the same style. For instance, value versus growth, or even quantitative, or any theme. About 10 years ago, the investment in mining industries was really hot, and for some years, investment in emerging markets is very hot. So for investors, especially for large institutional investors, when they have asset allocation, for instance, of $1 billion into equity, that's the bucket of equity. Within that asset class of equity, they have choice of passive versus active. They have choice of value equity managers within the active bucket. They can have value, thematic, and growth managers, or all the other available investment philosophies. They are all following an active management process. So we're going to talk about this. Investors actually can benefit by diversifying their exposure to a particular investment style. So consider this $1 billion asset allocation into equity. If you're going to give that $1 billion to one single manager, of course, it's a very concentrated risk to that one particular person, not just the investment process, that one particular person as well. What if something unexpected happens? What if that portfolio manager leaves the fund? So that's very concentrated risk. It's very unusual for large institutional investors like the superannuation fund in Australia. They give $1 billion, even large amount of money, their total equity exposure to one manager. That's usually the case. They allocate that $1 billion or $10 billion of equity funds to a few managers. And these managers may have their own expertise, for instance, investing in value stocks, investing in emerging market stocks, or whatever they believe they have expertise in. So the institutional investors is trying to diversify that particular manager risk within the total portfolio. To identify these, how we're going to classify these managers into several buckets, we may run correlation of the portfolio returns, or we may run regressions, have a look at the R squared, how they're going to explain by common factors, and then we're going to have some rough understanding how we're going to classify these managers into different styles. Then we think about, how much diversification benefits or how the risk-return trade-off of the total portfolio can be improved by allocating funds among a couple of managers. So here we have a hypothetical study of 3 managers, and we have value manager, growth manager, and a thematic manager. For each manager, if you're going to give that total equity allocation, for instance, to one of these managers, and you're going to generate excess return of 2.8% for the value managers and 0% for growth managers, unfortunately, over that period, and 1.4% for the managers who trade over themes. so whatever hot in the market. And also they have a very similar level of tracking error. So that's the same level of deviation from the benchmark that's used to evaluate their performance. So if we allocate all of our equity funds to one of these managers, we're going to have quite large swing of excess return that can be as low as 0% and as high as 2.8%. And they generate the same level of tracking error. And that's what you probably will observe on the graph on the left. So the blue line indicates the value managers' active returns, and the red line indicate the excess return generated by the thematic managers, and the green line indicates the excess return generated by growth managers. So that's quite big swing of active return for investors' portfolio, equity portfolio, over a period of time if you do not diversify that style, investor style risk. Then, okay, why not I allocate my funds to 3 of the managers? So each of them will take 1/3 of my total asset allocation into equity. So here we have different combinations of combining multiple managers of different styles. So when you combine 3 managers together, you generate, on average, 1.4% excess return with 1.6% of tracking error. So obviously, there's less swing of active returns. That's the black line you're going to see here. So that's the line you probably want to achieve. Much smaller swing of active returns, given a very reasonable level of tracking error. 1.6% is well below 2%. So when you include 3-star investment styles within your equity portfolio, you benefit from the diversification benefits of the different styles of the managers. But at the same time, you maintain a very reasonable level of active returns at a very reasonable level of peer risk. So this process demonstrates the important benefits that institutional investors might receive if they diversify across different styles within a particular asset class. How can they provide this much better risk-return trade-off? You will find the evidence at the bottom of the table, which is this, the negative correlation of these of the portfolios following different investment strategies, investment styles. So they tend to provide a better risk-return trade-off for the investors' total equity portfolio. This is so-called simulated study, or based on very restricted sample. In different markets, under different definitions of the investment styles, you probably will have different results. But the general message is that if you have large amount of money, don't put them into one basket. Don't hand over the money to one person. You probably want to diversify across several managers. That's usually the case. If you got to have a look at the DC funds of UniSuper, choose one particular product, you will see that a lot of these products, a lot of these portfolios have an asset allocation across a few managers. For instance, if they have an exposure to Australian small companies, again, Australian equity market is small, and Australian small equity funds the number of Australian small equity funds is still very small. So if you're going to allocate all of your funds, you want some exposure to Australian small companies. If you allocate all of the funds to one manager, you are subject to very concentrated investment style risk of that one particular manager. So that's usually the case for institutional investors. They divide that bucket into several smaller buckets and allocate them to different small Australian share managers. You may find these examples from a lot of institutional investors. That's very common practice now. The manager selection, of course, the institutional investors will have more resources, and also they are more sophisticated investors than individual investors. So here on the right-hand side, we have a survey result that they ask the institutional investors, how are you going to select managers? Okay, if you're going to allocate some funds to Australian small shares, there are 5 or probably 10 Australian small company managers in Australia. How are you going to choose a few of them? So here are the considerations, or the most important considerations when institutional investors choose the managers. First of all, historical performance. Performance analyzed to understand source. Do they do the manager selection based on the best historical return? No, they do not select managers based on the best historical return. But they do analyze the historical performance of these managers and try to understand the sources of especially the sources of the active returns, the alpha. And they try to disentangle alpha from the total return and from beta exposure. They try to understand how these managers generate alpha and how they have performed, not actually based on their historical performance. And the existence of an established track record. So the track record is not simply just the latest few quarters performance. So how long they have been in the industry and their performance in the past several years and with different funds, and how well they have been factoring themselves in the industry. And then the fund size, the capacity level of the strategy process. So that's a very important consideration when you try to invest in an active product. For most of the investment process or investment philosophy, the ability to generate alpha is limited, especially for upper limit. When the size of the funds grows when the funds of the funds under management is very close to that hurdle, the ability to generate alpha will be diminishing. For example, if the funds under management of Australian value manager is growing and growing because of the really stellar performance in the past quarters, up to a limit, they're going to put a cap. No more new investors. Because the more funds you have, the larger funds under management, any buy or sell order from the fund will be more likely to move the market price. That will erode the opportunity of generating alpha for the manager. So capacity of a fund is an important consideration. Of course, with the size of the fund, the absolute size of the fund, and how they're going to serve their clients are going to be considered, but the most important is how the capacity of the fund is going to be associated with their investment philosophy. And lastly, for institutional investors, they 8 out of 10 will say, okay, we don't really choose the cheapest managers. So with institutional investors, with the sheer size of the funds under management, they might be able to negotiate a lower fee, and they probably don't worry too much about the fee, but at the same time, they are more worried. They're more concerned about the expected performance of the fund. And 2 of them will say that fees are not important in the manager choice. So with institutional investors, with more resources within their discretion, they care more about the return, not really much the fees. And also, if you have a deal with the brokers, you probably will have deeply discounted brokerage fees. So lastly, complementary with overall portfolio. So how this manager will fit into the total portfolio. That can be in quite different considerations, like the particular expertise, the particular information content, new information content brought into the total portfolio, how the managers, especially historically, how the portfolio has been correlated with the existing assets within the total portfolio. So all of these should be considered that managed at total portfolio level when they choose a manager for one particular asset class. So based on our discussion of how active managers generate active returns and how managers are chosen by the institutional investors, we come to the debate of how can we allocate our funds to passive products or active products. Within your assignment, most of the total return index are from a passive index. For instance, equity and fixed income, so-called passive index. So all of these are naturally just a passive investment option. If you're particularly interested in advising your client to invest in an active product, for instance, Australian equity, you might do so by going to change the expected return of Australian equity, and in this way, you're going to incorporate portfolio tilting or actually adopt an active approach in the Australian equity. So of course, the fee has to be inflated if you're going to choose an active option for the Australian equity asset class. So it's naturally a choice for investors whether to go with the passive index or active product. Traditionally, we understand that we follow the teaching from classic finance textbooks. The market is generally efficient, and active management is a zero-sum game. So the net gain will be zero if you consider all of the participants in the market into your calculation. And also, they believe that the active managers, they charge the fees too high, and they cannot really justify that high fee for the active return they generate. So these people will go, okay, for investors, you should go with the passive because the active management will not generate any benefits on average. On the other side of the debate, especially the managers who are adopting active investment approach, they believe, okay, we are not average person. We are not average manager. We have the superior information, superior skills, and we are able to generate alpha. Market is not always efficient, and we are able to identify that temporary mispricing to generate active return. even after fees, we are able to generate a positive alpha for investors. So these are two arguments. It depends which side you're going to be. If you're individual investors, you have to make a decision. And most of you will go into the finance industry, you probably will be on the active side of the debate. Of course, if we're going to work for Vanguard, things will be different. You probably will be more likely to join the passive side of the debate. So the choice of active and versus passive can be totally dependent on the investor's belief and the applicable tax or transaction cost involved in the investment process. There are some instances that passive is not an option at all, or it's not an appropriate option, and the investor has to take an active approach, or they would like to take an active approach for a better risk-return trade-off of their total portfolio. So we're going to take 5 minutes break. Then we're going to discuss one of all of these options and considerations one by one with examples. This is examinable in the final, so we're going to spend more time on this. If you have any questions on the assignment, you're welcome to come to talk to me. A few groups sent me email yesterday and maybe this morning as well, asked for additional data or question. I only had time to reply your email before the lecture. The whole morning I was busy talking to students. So if you want to check your email right now, you will find the reply. I'm quite surprised that until now, it's week 11, end of week 11, you're still doing the quantitative modeling and invariance optimization. So at this point of time, you should be focusing on writing up your report. But that's part of the expectation. If I give you an extension of the assignments, you're going to delay the work for another week. Anyway, if you need any help, try to come to talk to me. Sending me email is fine, but the reply will not be guaranteed straight away, especially in the last 2 weeks. are your average? Okay, so if you the reason
不同类的。
discuss the inputs. Inputs. You're not forecasting value. You're it's optional. Different things. Forecast the portfolio value. How
we
do you
should
do
also-
that? Yeah, if you after the allocation
Yeah, yeah, yeah.
and you forecast the portfolio value, Okay, for investors, obviously the passive investment option will provide probably the best option at low cost. But there are some situations when the passive is not an option at all. For instance, when no readily replicable index is available. So no readily available or replicable index is available. So what kind of asset class? You cannot really find a passive investment option at all. What will be that asset class? No passive index? What's that asset class? Can you think of any? Most of the alternative assets, you won't find a passive index at all. What are they? Yes, private equity. There's no passive index available for private equity or hedge funds. Even though they're labeled as funds of the funds, it's not a passive index of all of the hedge funds in the world. And with some alternative assets, for instance, listed properties, commodities, we probably have a passive, so-called passive index. But with the unlisted properties, there's no passive index at all. So there's no way that you can hold a portion of all of the direct properties in the world. So no passive at all available for investors. So that's the case. Investors, if would like to have exposure on direct property, private equity, hedge funds, they have go to an alternative or active product. And sometimes the passive alternative is not suitable at all. For instance, the passive or cap weighted index doesn't at odds with the investor's objectives. Can you think of an example of a passive index not actually suitable for investors' objectives? Can you think of an example of that? For example, fixed income index. If I want some exposure, I want to have some asset allocation into fixed income securities. I want the fixed income securities in my total portfolio as a diversifier of the equity risk. I don't care if the passive is efficiently constructed or not efficient constructed. I just want fixed income exposure. I don't care. But some investors, they really want some custom, tailored, managed fixed income portfolios. Who are they? I'm okay with passive, so-called like Barclays Global Fixed Income or Australian Fixed Income. I'm okay, because I want to include this in my total portfolio to diversify the equity risk. But one particular kind of investor, they hold fixed income security for a very particular reason. They don't want the passive index. Usually, they are not appropriate. Who are they? That very particular kind of investor, institutional investor. Who are they? Can you think of any? Think about the table we discussed in lecture 2 of different investors, different objectives, individual, fund managers, insurance companies, endowment funds, superannuation fund, DB, DC funds. Of these investors who would not usually hold a passive index, or probably the passive index is not appropriate for their objective. Who's that? Anyone? what are the characteristics of the passive fixed income index? Can you remember anything from week 7? So these are passive index. They are constructed by sampling. And they have their own particular traits or profiles. For instance, the duration of one particular fixed income index is 4 years. The other index will be 6 years. I don't really mind too much about the duration. But one particular type of investor will care a lot about the duration of the fixed income securities within their total portfolio. Who are they? Hey? Yes, DB funds. The fund contribution fund, their objective is to manage the portfolio to meet the projected liabilities. They usually manage the portfolio to the asset allocation by matching the duration of their portfolio, especially the fixed income securities, to the duration of the projected liabilities. So if the DB fund has 5 years of duration from the estimated liabilities, of course, the passive index of 6 years duration is not appropriate. So they usually require customized management of their fixed income portfolio instead of going to buy a passive index. Even though sometimes they might have passive index, but they still have a specialized team to manage the total exposure of fixed income securities, so that the duration of the fixed income portfolio will match in some way to the projected liabilities. So that's the example for the defined benefits funds. The cap-weighted index, particularly fixed income index, is not appropriate for DB funds when they have a particular need of duration of the fixed income portfolio. And the next one, the standard cap-weighted index is inefficiently constructed. So if the investor would like to have particular exposure into some industries or into some exposure to some particular countries with this passive index, for instance, fixed income, they are constructed by sampling. So you probably will not get the exposure you want or you desire. So with these 3 situations, you probably want to go with the active product instead of the passive product. And when active management is expected to outperform the index, or in other words, you probably have some assets, you have the potential to generate positive alpha. So what are these assets? Can you name a few that may be more likely you can generate alpha? So if I compare Australian equity and emerging market small companies, with which product you're more likely to generate alpha? Emerging markets equities. So these products, they are temporarily inefficiently priced, and you might have the potential to generate alpha or active return. But with that favorable investment environment is not sufficient yet. You do have to understand how the companies in the emerging market they behave, what are the differences in terms of business environment, accounting, reporting requirement, and also do you really understand the development of the particular industries in the emerging markets. So you need favorable investment environment, temporary inefficiency in pricing, and also you do have that superior expertise or information to identify these investment opportunities. So with these two factors, these investors might choose the active product over the passive. So lastly, of course, if you have strong belief of the skills of some particular managers, you probably want to prefer an active product. So with your assignment, did you choose mostly passive, or some of you tried to advise active products? Mostly passive? Anyone tried to include the active product in the total portfolio? Any team did portfolio tilting? No? Okay. Lastly, another aspect in the asset allocation process is actually the costs of doing so, or the cost of constructing the portfolio. So the most important cost for investors is actually tax. Only after tax return is relevant. And before tax return are still widely reported in Australia, and we are still quite far away from mandatory after-tax reporting. But it's like common practice in the US market already. So the tax on dividends can be quite straightforward. We discussed this in week 6. So with the imputation credits that comes with the cash distribution of dividends, and it's quite straightforward to calculate the applicable tax. But the complication comes from the realized capital gain tax. We have 50% concession on the realized capital gains generated by investment held for at least 12 months. And also with investment in Australia, no matter it's share investment or property investment, there are negative gearing in place so that investors will benefit from these tax concessions. After last weekend's election, at least we have certainty that negative gearing is not going to be scrapped for investors, especially for property investors. So the accounting and calculation of capital gain tax is particularly tricky for investors. Usually, this is not going to be considered when we do the strategic asset allocation, but it has to be evaluated when you consider implementing the asset allocation advice. For instance, from your assignment, you understand that to meet the objective, the absolute return objective, and also satisfy all of the risk constraints of the client, you probably will have a quite diversified portfolio. That diversified portfolio will have significant capital gain tax implication for the investor. So at least right now, the existing portfolio is 60% in direct property. You probably will have to sell most of that direct property holding to buy other asset classes. And also, you probably, currently there's about 30% of exposure to Australian equity. If you want to increase that, you have to sell the direct property. So you have to pay tax, realized capital gain tax, if you sell the direct properties, no matter it's the family home or investment properties. You are going to be left with less money in investing if you decide to go ahead with the recommended asset allocation. Of course, you might decide, okay, I don't want to pay the capital gain tax. I'm going to stick with the suboptimal asset allocation. So you're going to present the case of the trade-off, benefits, potential benefits, and the cost of this asset allocation. Especially for investors, when they consider the tax implication, it's important that they capture the tax puzzle. That's probably more like accounting or tax advisor's job. But I'd like you to understand this just as a general understanding. So if you consider an equity, a total portfolio that includes the equity, fixed income, and direct property, of course, with the direct property, if you sell it, you have to pay realized capital gain tax based on the purchasing cost. For instance, that will be the most straightforward way to calculate realized capital gain tax. But what about stocks? For instance, within my portfolio, I have 5,000 shares of Woolies. So I'm going to have 5,000 shares. 1,000 of them were purchased very long time ago at 50 cents. And 2,000 shares were purchased as $1. And 2,000 shares purchased some while ago when the share price was $3. And right now, the share price is $2.50. So the capture the tax puzzle means that you do the trade, or when actually you do the accounting of the shares, you make sure you maximize the tax benefit. So with the 5,000 shares of Woolies, now price is $2.5. If I look at my inventory, it's not physical inventory, it's like a number, some numbers to show up in some accounting software, for instance, MYOB. So they're going to show that I have these inventories of 5,000 shares of Woolies, and you have to choose which 1,000 shares you want to sell if you want to reduce your exposure to Australian retailers. So which one you're going to choose? The 1,000 shares of with purchase price of 50 cents, or the 1,000 shares from which that purchase price was $1, or you choose $1,000 from the inventory that you purchased at a price of $3. Which one is beneficial if you have 3 buckets of inventories? If you have to take 1,000 shares out of 3 buckets, which bucket you're going to reach? Which one will benefit you from the tax purpose? Yes, so you're going to have realized capital loss. If you're doing other trades at the same time, this capital loss will be used to offset the realized capital gains of other trades, so that you're going to pay less tax. This is called capturing the tax puzzle. So for individual investors, this can be quite straightforward. You go to in your spreadsheet or your accounting software, you can identify the inventory of the shares and to decide which inventory you want to sell to make the most out of the tax concession or tax capital loss. But what about institutional investors? As we have discussed in this lecture, institutional investors, they allocate, for example, equity, $1 billion to 12 portfolio managers. And now they want to reduce exposure, for instance, of Australian banks. So they were really hot topic in the media since last year. So you believe, okay, these Australian banks sucks, and I don't want to hold them anymore. And you want to sell some Australian bank shares. You have 12 Australian equity managers. How can you decide? So this process requires an overlaying management across all of the 12 managers, Australian equity managers. So it's not going to be like I make a call and ask each of these Australian equity managers to sell the same proportion of Australian banks. So They're going to check very detailed inventory of all of the Australian equity managers that are holding in banks and try to identify the most beneficial tax parcel to make the sale. So that requires overlay management on the top level for the institutional investor. Other costs in the funds management will be, for investors, will be the fund administration. That's usually charged at a percentage, and up to some limit is going to be capped. So if you want to go to have a look at the Colonial First State or even UniSuper, you will have some ideas how much they charge for the fund administration. And also management fee is a percentage of the funds under management. Transaction costs, if you're actively changing the asset allocation of your portfolio, you probably will have to pay commissions, and also you have to pay for the bid-ask spread. And for some institutional investors, and especially they want to buy or sell some small companies, even some medium-sized Australian companies, the buy and sell order will impact the market price. So this might partially be counted as the cost of your trade. Of course, tax impact. There are other opportunity costs if you probably want to consider when you decide if you're going to trade or not. So sometimes you're stuck with illiquid assets when you want to trade. There's no counterparts of the trade, and you are stuck with that illiquid assets, or you have to live with suboptimal asset allocation. It depends on your ability absorbing this negative impact from the suboptimal asset allocation. If you have high need of liquidity or cash flow suddenly, and this can have a very negative impact on the life of the fund at all. And also sometimes because of the illiquidity, because of the price movement of a particular asset or a group of asset classes, you cannot rebalance your portfolio because you need to sell the illiquid asset to rebalance your portfolio back to its long-term strategic asset allocation because of the illiquidity, and also sometimes this may be temporary and everybody is trying to rebalance the portfolio is going to be extremely hard. And also cash need, especially for funds, like if they have expanding program to support, or they have pensioners within the DB funds, they have to pay the cash to meet the liability requirement of these pension fund members. In this table, we have a general statistic of the management fee or expense ratio for some very popular investment products. You will see Australian super funds. The personal master trust, it refers to retail personal super. So, for example, if you're working on a part-time job, and with that $50 you save every week, you want to put them into a personal superannuation account. It's a retail personal super account, and it's going to be charged at very high fee, like close to 2%. But if you join an industry super fund, for instance, UniSuper, or there's particular super funds for people working in hospitality industries, you're going to be charged at a much lower rate. And you probably have found out that Vanguard Australia international shares of close to 1%, and even the Australian super is close to 50 basis points. In Australia, Vanguard charges higher management fee than the US market. That's probably something we have to live with, the higher labor cost in Australia, and also the operational cost, compliance cost may be much higher. Or sometimes they believe they do have a very comfortable margin in Australia market. So because of the concentrated investment market in Australia. Only a few large fund managers taking up nearly 90% of the investment market. They do have very strong bargaining power, charging investors very high fees. If you go to have a look at AMP, MLC, and Colonial First, for example, you may compare the management fee of the three managers on the same products, for instance, active Australian shares. You will see they charge a very comfortable management fee of about around 2%. And if you invest in some fancy products, for instance, leveraged Australian shares, the management fee can be well over 3%. On the right, we have the average expense ratio of hedge funds, private equities. They are much higher than equity mutual funds, like close to 4% for private equities. It can be as high as effective, can be 6%. With the bond mutual funds, the fee is much lower, and they are usually half of the actively managed equity funds. With your assignment, you're given the fees, one column of the passive option and the other column of active. So depending on your choice, your final asset allocation, and you may calculate an estimated weighted average fee, and you probably want to report this in your final reporting of the portfolio outcome. Particularly on the first page when you lay out the portfolio forecast. Turnover and fees. So how turnover is associated with the transaction cost, especially brokerage. So with the typical turnover, like Vanguard Australian shares, the turnover is below 10%. So whenever there's change of the index, there will be buy and sell within the Vanguard Australian share index. So the turnover is about 10%. And with the active managers, the turnover is close to 50%. And some other more active managers, the turnover can be 80%, even 100%. And for some quantitative managers, they are extremely active, making a lot of buy and sells. The turnover can be 150%, 200%. So when we calculate the turnover, the percentage, we actually add up the value of the total sales and the total value of buys and divide the value by 2. And then divide that by the total funds under management. That's how we calculate turnover rate. So when you have a look at that turnover of 10%, so that means that if my funds under management is $1 billion, there will be 2 times 10% times $1 billion of trading value over the year. So that's going to be the base to calculate the brokerage. And you have that $500,000 of brokerage generated from a passive index fund. That's a lot of money for one particular client of a broker. And if you look at the extremely active quantitative managers, with a turnover of 150%, the brokerage generated from the transaction can be close to $8 million. That's going to be deducted from the funds under management. Investors are going to pay for that brokerage. So in other words, it's going to be deducted from the after-tax or after-fee portfolio return. It's going to be substantial cost for investors if you invest in an active product. So it's going to still a trade-off. You have to evaluate the trade-off, the potential expected active return, and this high cost as a result of high trading turnover. Okay, so that's it for today's lecture. Next week, we're going to continue our discussion of other topics to round up our understanding of the whole package of asset allocation. And also, in the second half of next week's lecture, I'm going to give you a review of the most confusing topics over the entire 12 weeks, and also the most important points that are going to be covered in the final exam. And also, I'm going to talk about the final exam itself as well, the format of the question, and particularly the strategies of having a higher mark in the written part of the exam. Next, we have some time. I'd like to go back to look at the writing exercise we did last week. I found out that something very interesting, that after you submit the response last week, a few of you went back to edit your answer. And surprisingly, and I'm very happy with the result, and you do get the point of writing more effectively. I'm very happy about that. I was worried that after if all of you edit your response, I don't have the example to comment on. But luckily, we still have a few responses we can discuss or have the potential to improve. So if you have the tablets or smartphone with you, you may still go back to the Wattle site. And still write something there to contribute to the question. Oh, it doesn't. Okay, it's better now. So let's read the question again. So given the clients in your assignment, objectives, constraints. Currently, the client has 65% exposure to direct property, 30% exposure to Australian equity, and about 10% Australian fixed income or cash. So that's the existing portfolio. I would like you to advise some asset swaps so that I might have a better risk-return trade-off of the total portfolio. So in other words, I want you to identify the fundamental risk factors of the existing portfolio and advise the potential asset swaps that will help the client to achieve a better risk-return trade-off. Here, risk-return trade-off doesn't mean standard deviation return trade-off. Instead, it means fundamental risk-return trade-off. So, where is that response? I wanted to use that. Okay, so hopefully you still remember the responses, especially the first two we have discussed last week. So from my memory, it's like swap into world equity for growth or world fixed income if defensive. That's one of the top responses from last week. So I commented on that response. You failed to identify the risk factor you're trying to diversify and lay out the potential benefits of doing this asset swap. So that's why we have the first two responses. They are very good. So the first one, high asset weights in direct property makes the client highly exposed to risk of Australian economy. So concentrated risk of Australian economy. Diversify this risk. Advise swap the direct property to world equity or world fixed income to diversify the concentrated risk to Australian economy. And also it discusses the illiquidity risk of direct property. So to address that, advise the client to swap to Australian fixed income or Australian equity to improve the liquidity of the total portfolio. So that's with that response, in an exam context, you probably will get very close to 85% to 100% of the total marks available. So if you consider the first response we received last week, that switching to world fixed income for growth, for world fixed income for defensive, so this explanation is much clearer to identify the fundamental risk you try to diversify and why this asset swap will diversify that risk. In other words, improve the risk-return trade-off of the total portfolio. The second, the current portfolio is highly concentrated in Australian assets. So although it's not very clearly identifying concentrated risk to Australian economy, but I understand that all Australian assets, so that will be concentrated risk. And swap will to some other country properties with similar risk and may have the same return but lower risk. So this is a little bit confusing that you want to swap to other country properties with similar risk. And then the new portfolio may have the same return but lower risk. The lower risk, if that is replaced with lower Australian economic risk, is going to be much clearer in terms of you're trying to diversify the Australian economic risk. And with that answer in exam context, it's very likely in the exam I'm going to be very specific to ask you discuss like one risk factor or two risk factor. If the question asks for advising on diversifying one risk factor, you probably will get at least around 70% of the total marks available, just depending on the clarity of your writing, of your answer. That swap for what fixed income if defensive. So that's the example of not very clear of the identified risk factors, and also the word choice of defensive, more return, they are vague or not concise at all. So when we say swap for what fixed income for if defensive, so what's defensive? You can't just use the words arbitrarily. When we say defensive, it's in investment context, we say defensive stocks. So defensive assets, they probably have a lower correlation with the market than the cyclical companies, for instance, or like building materials. So the defensive stock can be infrastructure, some infrastructure stocks, some retailers like Woolworths. So when the economy is not performing well, you probably will have these stocks within your portfolio to diversify the volatility of the cyclical companies or the riskier assets. So that's what we mean defensive. So obviously here, you probably want to, you have the ideas of choosing between world fixed income and world equity in terms of the risk tolerance of the investor. So that's my speculation. If I ask someone to stand up to explain, you probably will get very embarrassed. So I'll just maybe just speculate. You probably want to take into consideration the investor's risk tolerance in the asset swap. So if the investor has high risk tolerance, you advise swapping direct property to world equity. If the investor is really risk averse, you advise swap Australian direct property to world fixed income. At the same time, because you nominated world fixed income, world equity, you're trying to diversify Australian economic risk. But you have to write these down to make the reader understand. So that's quite typical mistake or weakness in your writing. This morning, a few groups gave me their report to read. You probably have processed the information, the question in your mind pretty quickly, and you work out the solution and you put it down, world fixed income or world equity, but you fail to lay out the reasoning. There must be some reasons, beliefs that you form this opinion or advice. You have to put this down in writing to answer that question. Most of the exam questions will ask you to explain. So 1 or 2 sentences in the exam context will be sufficient. If you, before this, swap to world fixed income, if you state clearly the existing portfolio is exposed to concentrated Australian economic risk and illiquidity risk, period, that's 1 sentence. And then you say swap for world fixed income to diversify, world fixed income or world equity to diversify the Australian economic risk. And also this will reduce the illiquidity risk as well. Then you probably will get above 80% of probably close to the full mark to answer that question. You have to put down the reasoning why you advise these asset swaps. It's a shame that the response about the inflation-linked bond is gone. And when I checked this morning, it was still there. I probably don't try to ask someone to stand up to say it. So that's the last response we talked about last week. So I can still remember some of the words, the phrases that inflation-linked bonds, I can't really remember the exact things you tried to say. Anyway, you advise to swap to Australian inflation-linked bonds. And there are some meanings in the writing that they will protect the clients if Australian economy is not performing well or inflation is high, something like that. So still, that's a very typical witness in your writing that you discuss something generally. So you're right that you process the problem correctly. You identify that the client has inflation concern. That's why they require the portfolio to generate an expected return at least 3% above the long-term expected inflation. You are absolutely right, and you process that piece of information, and you are right to identify the asset swap, inflation-linked bond. It's a good long-term inflation hedge if held until maturity. And also, it's much more liquid than direct property. Just it's a shame that you didn't put this down in writing, and you were writing about the characteristics of the inflation-linked bond and the potential benefits of including inflation-linked bond, but the whole writing was not framed in the client case at all. So as a client, if I ask you the question face to face, I will see you were talking about inflation-linked bond. Okay, I get that message. You advise me to invest in inflation-linked bonds, diversify away from direct property. But I'm going to be left wondering, why? Why would I benefit investing in inflation-linked bond instead of Australian direct property? And in what way my risk-return trade-off can be improved? So with this original form of the response, the inflation-linked bond, you probably will get 1 mark. Or I would say probably 10% out of the total mark available. So you're right to propose that asset swap or the target asset swap, but you failed to explain why. The other response, the trend of real estate, swap to Australian fixed income for better return and more stable trend forecast. So still a very typical weakness in writing. This response failed to identify the risk factor you try to diversify. That trend of real estate, that recent housing market so-called slump, how this would have an impact on investors' portfolio? What's the asset swap? So you suggest to swap to Australian fixed income. What's the risk factor you try to diversify? You probably will have a better return and more stable trend forecast. I'm not quite sure about the trend forecast mean here, but stable for a better return is going to be very questionable. The expected return of fixed income is over direct property. You can't write things so arbitrarily as a finance student and a future analyst in finance. You go back to have a look at your own assignment model or have a look at these summary statistics from tutorial 2. Have a look at the historical average return of property and Australian fixed income and have a look at the expected returns. Is that the case? A better return and stable trend forecast. Probably you mean stable return or stable cash flow. So lower standard deviation. Have a look at the historical summary statistics before you make such claims. They are very vague, not concise. So with this answer, you probably will get about 10% of the total marks available. And that's not very clear explanation. So that's very vague, lower risk. After doing this course, you should have a very good understanding of risk. Is risk just standard deviation? I believe when you write down that fixed income to obtain lower risk, you're thinking about standard deviation. Standard deviation is not a risk measure. It's only a quantitative measure of return distribution. It's not risk. So you probably will get half or 1 mark, depending who's marking. Usually tutors will be more generous than me. Next one, it looks like illiquidity risk matters. Looks like you got the point. Okay, that's very good. Their cash flow needs in urgent times. And in this case, you are probably thinking about their transition to retirement. So probably they're going to have cash flow need after their retirement or even years before their retirement. That's very good. You consider the asset swap and also the risk in the client case, in the context. Downsizing, home buyers issue exists, Australian economic risk, that's excellent. If in the exam context, you can name just one or two fundamental risks, you probably, up to here, you have already got at least half of the marks, because you clearly identify the fundamental risk factors of the existing portfolio. And you didn't give a phrase like economic risk. It's Australian economic risk. And also illiquidity risk. You didn't just leave a phrase, illiquidity risk. You have to explain where that illiquidity risk comes from. It's from the direct property. So they decrease the proportion of direct property, increase investment in listed property, improve the illiquidity problem. That's excellent. So a switch from direct property to listed property will improve the liquidity of the portfolio. That's diversify one of the risks identified. And also investment in world equity fixed income, improve the concentrated risk to Australian economic risk. So with that response, you probably will get 100%, even from me. That's probably you try to learn to write in that way. Not just give me, leave a few phrases or half sentences in the exam paper. Write at a reasonable way, in a reasonable way. Oh, that's it. So no more responses. It's a shame that inflation-linked bond response is gone. It's a very typical thing that you write in the assignment and in the exam. Okay, so we're close to the end of the lecture. Next hour, I'm going to talk about the writing up the report. I'm going to show you 2 pages from last year's assignment. We're going to have comments, how we may improve these writings. And I'm going to let you guess the grade of this assignment. And also, if we have time, I have another writing exercise. During the break, if you have time, you might start writing there. I'll show you that. There's some problem with the echo today. Okay, you might take your break now. We'll start the workshop at 3:05.